The base metal index ended 2025 as the third best performing commodity asset, behind precious metals and livestock, matching its middle of the group position posted last year. However, what is vastly different is the performance on a percentage term basis, in which base metals posted double-digit gains in 2025 versus a very modest performance in 2024. Now, if we take a look at what drove this performance, we can see at the start of the year, the index posted continued higher prices, driven by a warming in expectations for US federal interest rate cuts, rising concerns over smelter production cuts in China, and Section 232 tariffs triggering supply concerns, especially for copper and aluminium. However, by Q2, all gains were lost, driven by escalating reciprocal tariffs on a global basis, creating panic sentiment, triggering a sharp decline in risk assets. And as a result, on the Shanghai Future Exchange, metals like copper experienced a limit-down drop after many years. By the middle of 2025, under the dual effect of low copper prices and US export rush, copper prices steadily rebounded, taking with it the rest of the suite. Looking to Q3, despite seasonally being an off-season for industrial commodities, a flurry of supply disruptions underpinned prices, before a perfect storm of factors in Q4 resulted in copper and tin posting record high prices, alongside aluminium posting a multi-year high. Now, this perfect storm came from, firstly, a warming in the macroeconomic outlook, with China-US tensions lowering, the Federal Reserve moving to cut interest rates 3 times in 2025, China outlining metal-intensive spending in the year ahead, the end of the US government shutdown, and tentative talks of peace in Russia and Ukraine. Secondly, from fundamentals, on the back of historically high levels of supply risks. Thirdly, from US Section 232 tariff risks, creating tightness outside the US for metals like copper, aluminium, and more recently zinc. Altogether, increasing capital inflows towards the complex by year-end. Now, if we look at the base metal index on an 8-year chart, we can see that prices have broken and held so far above the new normal trading range that's been created over the last 3 years. And the question that everybody is asking is, can these gains be sustained? And this is what I'm going to address over the next 10 minutes by outlining the realities we see across the macroeconomic landscape, the fundamentals, tariffs, and investors. And I'll be going in the order of best to worst performing base metal over 2025. So, of course, we start with copper, which pipped in to be the best performing base metal last year, posting a record annual gain of 41.7%, driven by a perfect storm of factors across all key price drivers. Now, we've already mentioned copper's benefited from a warming in the macroeconomic outlook, but within the fundamentals, we've had a year in which an elevated disruption rate in key producing countries such as the DRC, Indonesia, and Chile has pushed the market into deeper deficits in 2025 and 2026, both on the refined and concentrate side of the market, with market participants still adjusting to a record low environment for refining and treatment charges. Meanwhile, the expectations of future US import tariffs on refined copper have single-handedly been responsible for global trade rerouting, creating tightness outside the US, with more than 1.1 million tons of copper having entered the US last year. And this in turn has encouraged elevated interest into copper from the speculative market at an aggressive pace. Looking to the very near term, with holding a further downward shock to the macroeconomic landscape, we expect copper prices to continue to be led by the somewhat misunderstood sentiment from investors over US copper-specific tariffs, with a focus on regional level of global stocks and material entering the US, rather than underlying global fundamentals such as demand. In turn, we expect copper to trade within a new higher normal range over this period, posting bouts of volatility within the forward curve. However, looking across the year, we see prices for copper above $13,000 per tonne as unsustainable, with downward pressure likely to come from several factors. Firstly, the very real potential that no tariffs are imposed on refined copper from the US. The CME-LME arbitrage is currently only pricing in a 5% chance for tariffs by the end of the year. Therefore, in the absence of an attractive premium, we do not expect the same level of inflows as last year. Now, having said this, it is evident some material is still entering the country based on COMEX and LME warehouse numbers, but this is likely stemming from long-term deals with producers that were made last year. Now, secondly, we see speculative positioning as overdone and unrelated to the realities in the market. Thirdly, in the fundamentals, while we have copper in a deeper deficit market year on year in 2026, we still do not see the market as historically out of balance. And although supply risks do outweigh demand slowdown, driven by higher prices and a slowdown in Chinese consumption, fundamentals certainly do not support copper at the current levels. Meanwhile, we do expect copper to return back to its Dr. Copper status and be impacted by the wider outlook for the global macroeconomic backdrop, which contains a host of downward risks. Now, the second best performing base metal last year was tin, which ended 2025 up a significant 39.4%, having held a position as the best performing base metal over the majority of last year. Now, the key price drivers for tin have stemmed from the fundamental and speculative sectors of the market. In the fundamentals, we've had inflamed supply-side risks, with over 40% of global supply having faced a form of disruption last year, particularly in key producing countries such as the DRC, Indonesia, Bolivia, and Myanmar, set against resilient and fast-growing demand associated to tin's use in renewable energy, new digital applications, and energy storage. And as a result of this and tin's longer-standing outlook, in which the International Tin Association forecast a record deficit of 13,000 tonnes by 2030, driven by a lack of investment in new mines, tin has seen a surge in global interest from the speculative market, with LME net longs hitting record levels by December. For the year ahead, while supply risks remain prevalent, given that Indonesia, the second largest producer, has vowed to close 1,000 illegal mines in the country and return back to a one-year mining license program, in addition to a very slow return in production from Myanmar's Wa State Man mine, limiting availability of tin ore to China, with Myanmar the largest exporter. Now, we do expect refined output to accelerate by 1.8% year on year from just 0.3% gain last year. However, this is not enough to offset demand, pushing the market into a third year of deficits. Therefore, we see tin as a metal vulnerable to the upside, especially given the impact from investors, given its smaller market size. However, we are cautious that the price is likely to face a reality check, given that global stocks are back to levels at the start of 2024, while the stretch levels in the speculative market are often accompanied by sharp reversals. Now, aluminium ended 2025 as the third best performing base metal, with an annual gain of 17.4%. We see the outlook for aluminium as one of the most complicated within the suite, with a relatively balanced global market hiding the realities on the ground, in which regional narratives may muddy a clear market trend. In simple terms, the big picture for aluminium is that supply is set to be healthy in 2026, despite concerns arising over China, the largest producing country, set to reach its capacity ceiling of 45.5 million tonnes in the year ahead. Now, we expect the country to record another record year of output in 2026, which, alongside significant capacity build-out in Indonesia, should offset declines in production from regions such as Europe. And this is set against modest demand outside of China, with advanced economies in recovery mode, while within China, domestic demand is set to slow on front-loading last year in fast-growing areas of demand like renewables, power, set against challenged export demand on the back of cancelled tax rebates in Asia ex-Chinese market, and the imposed US anti-circumvention tariffs on aluminium semi-processed material. However, with historically low global stock levels and the increasing involvement of speculative interest in aluminium, prices over the year are highly susceptible to volatility, with underlying fundamentals taking a backseat, at least in the near term. Nickel completed 2025 as the third weakest performing base metal, rising 8.6%, reversing declines over the previous 2-year period, with gains concentrated solely in the final month of the year on Indonesian supply concerns, with Indonesia being the largest producer in the world, accounting for 60% of production. Now here, in addition to Indonesia moving back to 1-year mining license programs from a previous 3-year one, alongside the introduction of new mining royalties, which took effect last April, increasing production costs in the longer term, the latest move from the country in December has increased concerns about future supply, with the Indonesian government proposing in its 2026 work plan a 34% reduction in output, set to result in production being pared back to 250 million tonnes this year from 379 million tonnes last year. However, despite these factors and low nickel prices themselves creating supply concerns, having hovered below $15,600 per tonne for the majority of the second half of last year, putting increasing pressure on both mine and smelter profitability, especially outside Indonesia, we still forecast that the nickel market will remain in a building surplus pattern in 2026, with price gains limited by healthy production from Indonesia's integrated projects, contributing to already high inventory levels, which are expected to further build on the fast-tracking of Chinese and Indonesian brands. Zinc closed 2025 as the second weakest performing base metal, with a price gain of 4%, with price softness versus the rest of the suite driven by frail demand dynamics, with the outlook for zinc's largest end use in galvanizing steel, for example construction, under pressure from an ailing property market in China and downgrades to global growth due to tariff implementation limiting advanced economy demand. Meanwhile, on the supply side, the higher price point of zinc above the 2022 to 2024 level has helped the return of key mines such as Kipushi in the DRC and Tara in Ireland, easing a significantly tight supply profile over the previous period. Indeed, imports of ore into China reversed declines in 2024, and they've jumped 38% over the January to November period of last year, encouraging annual treatment and refining charges to lift to $160 per tonne from a record low of $80 per tonne in 2024. Now, in the year ahead, we expect zinc to continue to post building surpluses, with a rebalancing in global stocks likely to limit zinc's recent upward trajectory. Furthermore, we await the conclusion of the executive order into critical minerals under Section 232, which may prevent traders from sending material into the US, further easing tightness on the LME. Now finally, lead ended 2025 as the weakest performer, up just 3%, reflecting a moderate backdrop for traditional industrial metal demand, set against a somewhat protected supply outlook, given lead's unique fundamentals, in which 2/3 of supply comes from secondary sources. In the year ahead, given that the lead market is well stocked, with LME inventories well above 5-year averages, and a muted outlook from investors, given lead's limited use in the green transition, a lack of price direction could result in lead taking its price cues from copper. Now, on a medium-term basis, we see bullish price prospects is limited, with the market set to post increasing surpluses, with robust supply growth and no convincing structural bullish demand narrative.